What's good, everybody? Welcome to today's video where we're covering the only ICT daily bias video you'll ever need again. Okay, so with daily bias, it's not a very complicated subject. I know it can be hard, but once you get it down to these two things, it can be really simple. So price can do one of two things. Price can either trade to rebalance an imbalance, or price can trade to highs or lows. That is it. That is the only two things the algorithm does. And once you understand this within framework and context, once you understand this, it unlocks daily bias for you basically. So we rebalance imbalances and attack highs and lows, obviously for liquidity. So if you take a look at the chart here, we are on the dollar yen daily chart, and keeping in mind what I just said, remember, we can rebalance imbalances or attack liquidity. Now, imbalances in the market are fair value gaps, but we can also call them internal liquidity, if you will. So internal liquidity is like an order block within a range and a fair value gap within a range, or any PD array within a range, okay? So for example, here we have a low, a high, and then we have a 62% retracement, which is in a discount. Now, this is obviously the daily chart, as I'm showing you daily bias, and we expand and then retrace. Now, where did price retrace to? If you take a look inside here, within the discount range, we had these two down close candles and the mean threshold of, we actually had the full fill of this imbalance. So what has price done as we trade higher and then retrace? It has retraced into an imbalance, right? So between these three candles, we have fair value gap and an order block. Now, what makes this high probability order block and fair value gap partner together within the framework of this low to this high retracement, and that gives us the discount we need. Okay, so we have rebalanced an imbalance. So our first thing. Now, secondly, we want to attack highs or lows. So within the context, with it being on Thursday and anticipating a reversal, we have low, high, Thursday into an imbalance to attack what? Buy side liquidity. So once we trade into here with the context we've been given, we can now target this high and think of that as our draw on liquidity. Now, to give you another example, over here, in this context of bearish order flow, and now our draw on liquidity is this order block, right? This order block here is the draw on liquidity once we're up here. Now, why is it the draw on liquidity once we are up here? Because of this, right? So price hasn't tapped the high, but its correlating pair has. So its correlating pair has taken the high, which counts as our external range liquidity, if you want to call it that. So our external range liquidity gets taken out. Now we look at the context. Okay, where's premium and discount? Discount is down here from this swing to this high. This below the 50% level is our discount. And if we've taken our external range liquidity, what do we aim for next? Internal range liquidity. So we've taken out our high, attacked our high, and now the algorithm wants to rebalance an imbalance within this swing. So from here down to this low down here, the green shaded area is our discount range. Do you see imbalance in here? And yes, our down close candle acts as the imbalance. So ICT always calls it like if you were painting a wall. So price or that wall has been painted up, and now you need to brush it back down to give the full wall its clean look. It's the same thing here. The algorithm has delivered buy side. It needs to come down to deliver sell side again before delivering buy side if we are bullish. So price trades to internal liquidity, and within the context, where is the next draw on liquidity? If we trade to internal range liquidity, our next draw on liquidity, or the algorithm's next move, is to attack a high or low, of course. But in this case, because we're bullish overall and have been bullish for a while, as you can see, price has been completely trading up, all bullish momentum. Our external range liquidity is up here. Now, until we take out this high, all of this on a 4-hour chart, all of this on a 1-hour chart, all of this movement up is aiming for this high. So until we take out the high, this is our draw on liquidity, and it will continue to be so. Now, again, just on a 4-hour chart, if we take this range to this range, now why this range? Because we took out sell side liquidity here, and this high because we took out buy side liquidity. As you can see, came into the 62% retracement, and we always want to be buying in that discount area. Take a look here. We have got our order block and our mitigation block. Well, it's actually a breaker, sorry, our breaker block. So we've got a low, a high, a low, a low, a high, a high. Trades back down into the up close candle, which is our breaker. Now, this breaker is internal range liquidity. Price is rebalancing an imbalance. And if we're rebalancing an imbalance, what do we do next? We attack highs and lows. Where is the external range liquidity? Well, within the context of the range, this high is the external range liquidity. Now, this could be a daily chart. I'm just showing you the 4-hour chart because it was a convenient example, but they both work the exact same way. This works on any time frame, this concept of internal to external range liquidity. If you draw your dealing range correct, a low which took out sell side to a high that took out buy side, this can be such a powerful concept. We look for internal to external and external to internal. Okay, we only look for external to internal if it is against our order flow, right? So for example, or if it's working in tangent with our order flow, I should say. Like if we took out this high, right? Some of you may be looking, you may be thinking, okay, external to internal means it should go at least down here and then maybe to internal down here, right? But that is not always correct. The way I like to use external to internal is if we take out a major swing high or a major swing low. So for example, if I can find the example really quick, like here for example, right? So this swing low is all by itself. It's all by itself, and it's really a long-term low because we've got 2 intermediate term highs either side of it, but I won't get into that for this video. That's a topic for another one. But this is an external range low, and as we sweep the external range low on the daily chart, we can now look for internal range liquidity. So within the context, you draw your range out. Why this high? Because this started the movement downwards, the really dynamic movement. Not this high, because this high was created, which yes took out buy side, but the next 2 candles started consolidating. This high really had momentum to this low, and then back up into the 62% retracement level after external range liquidity. So we've got our external, and then within the context, this mitigation would be our internal. But for the sake of this, I will measure the fair value gap here, and the mean threshold or 50% level of that gap is our internal range liquidity. So you can see external to internal in context works perfectly, and will work the same way internal to external works. So internal, and now where's the external range liquidity? Here, right? And then if you pair this with order flow, it'll work every time. If you get the order flow wrong, then it will hurt you, okay? So we start trading up. Now think about it. Mean threshold, internal range liquidity. Where's the external? Up here. Remember, this is all within context. Price creates a high, moves up, creates a low, balances this. Now where's the external range liquidity? Here. Does the same again, external range liquidity, takes that out and then moves lower towards this higher time frame. But that's all higher time frame work. And as you can see, once we break a low here, we have a shift in market structure. Where does price come to? Internal range liquidity here. Once we trade into here, where's our external range liquidity? Below this low. Okay, so see how it works in tangent once your drawn liquidity is correct. And that pretty much brings us to the end of this video. So if you did enjoy it and you did learn something and learn how to read daily bias is a bit easier, please do drop a like and drop a comment. I'll be getting back to you in the comments as always. Check out the links in my description and I will catch you in the next one. Thank you as always for watching.